Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets.
Ice raw sugar in New York. There are still two immediate features to consider here on my daily chart. One is real and one is possible. The real is the late September to date descending wedge pattern, currently 2102 to 2167, highlighted in dark blue on my daily chart. Late 3 weeks ago and again late 2 weeks ago, we had attempted breaks higher out of it, but both failed. Last week we had attempted breaks above and below, and today another attempted break higher. For all these forays, both above and below, there has yet been no definitive outcome to the dark blue descending wedge pattern as yet. But please keep a close eye on this pattern. The only thing that it has done is perhaps sow the seeds of, instead of regarding the action since late September as a possible descending wedge pattern, to instead be morphing into a possible larger bear channel pattern. I've placed the outlines of this possible pattern, which is currently 2073 to 2267, on my daily chart, but I have not fully bought into this idea as yet. Immediately below current levels, we have the congestion band 2140 to 48, made up of the 50% Fibonacci line of the March 21 to October 23 move, and the November 2017 high, respectively. This support proved enough over October to hold up the market, but last week was breached and broken, with prices down to congestion between 2084 down to 2069, but soon found the support there, being, I suppose, so close to the flatlining gold long moving average. That's currently at 2050, and they found it, how should I put it, uncomfortable, and reverted back up, which we are still seeing actually today, an attempt higher. On the top side, a little above the upper blue trend line, we have the narrow congestion band 2235 to 2237, which mainly seems to work right now on a closing basis. Further up, there's a lesser Fibonacci line at 2299, which was enough to cap the market 3 weeks ago, somewhat surprisingly. Whilst further down, well, there is an argument to consider the whole 2061 to 21 even as a single large congestion band. Now, the rising green short medium moving average, currently 2165, has intersected the market last week and this, and as I have said last week, I was not sure how good a support this would be, and even today, it is in between being an unknown factor and a nuisance. So to sum it all up, the current descending wedge pattern may soon be morphing into a possible larger bear channel, but it has not happened as yet. So I'd keep a close eye on it as just a descending wedge pattern. Should prices break, either way, from this pattern and not change to a bear channel, then whilst I cannot give a direction on this descending wedge pattern as we haven't properly broken one way or another, but I can give an idea of the size of the move in either direction if it happens soon. Thus, a primary potential move higher would be up in the 135 cents, with a secondary harder to reach potential higher target would be in the 155 cents area. On the other hand, a primary move lower would be around about 0.65 cents, with a secondary harder to reach potential lower will be in the 155 cents lower zone. That deals with the immediate real feature. Now to the possibility, and that is to look at the whole September to date action as either a topping action with potential back down to the 19 cent zone, or as a potential bullish half hesitation, potential up as high as possibly 26 cents. As I've already mentioned, this is all just a possibility right now and would require further study of the market actions and a resolution of the issue as to whether we have an ascending wedge pattern or a bear channel to see if it happens. But I do wish to make sure that you're aware of these possibilities rather than getting surprised at the last moment. Ice Europe white sugar in London. From the lopsided island top formed over late September, this market has been gradually moving sideways toward the lower, and in the process getting itself trapped between three moving averages until last week before escaping and seemingly getting itself trapped again in amongst the moving averages. So on the top side is the gold long moving average, currently 571.5. that has been assisted at a distance by the dark blue upper trend line extension and downtrend, currently at 589.5 of the January-September this year descending triangle, as well as in the past by the 50% Fibonacci line, the July 21 to November 23 move at 592.80. Then below, we had seen the support of the flatlining mauve medium moving average, currently 550.40, along with the March 2017 high at 548.70 and a lesser Fibonacci line at 550.20. These three worked together until last week, when prices sallied lower but were quickly turned back higher by a bullish hammer pattern last Wednesday, and with changeover as well. So we're back within the next of the moving averages, with the slowly declining gold long moving average overhead, currently at 571.5, today capping the market, and the mauve medium moving average breached but seemingly repaired below the market, and that's currently at 550.40. We also have the green short medium moving average, currently 561.40, and I'm not entirely sure of its importance, whether it's supportive of the market or a nuisance, as it has been in New York sugar. We did see a golden cross with the rising green short medium moving average moving up over the then rising mauve medium moving average 4 weeks ago. But as I said last week, and I quote, I suspect that this golden cross, much like the green short medium moving average, has more nuisance value than anything else right now, end of quote. Now, we also saw 3 weeks ago a weekly key reversal down, and as I stated last week, and I quote, I think this weekly key reversal down is of more value than the golden cross or even the green short medium moving average itself, end of quote, which proved to be true last week, if temporary. So once again, as I have also said last week, and I quote, in the meantime, until we break one way or another, the market seems capped by the gold long moving average overhead and supported by the mauve medium moving average below. Sugar white premium spread. 29 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London sugar month changeovers, but it nevertheless was a seminal moment and set in motion a lower market, though prices took their own sweet time in getting down there. Between mid-July to mid-September, the market had been testing the lows of early to mid-October last year, down in the 115 3/4 to 116 zone. I also noted many times that though we had been held up in that region for a while, this support may not have been as strong at the time as seen back in October 2023, and this proved to be the case. 10 weeks ago, I highlighted a significant weekly pattern, an immediate countering key reversal down and bearish engulfing pattern, punching down through the 115 3/4 to 116 even zone, and then down through the next congestion zone below, made up of lesser Fibonacci lines at 107 3/4 and 104.5. I spoke 10 weeks ago about the supports below, and I quote, there are lesser Fibonacci levels further down at 107 3/4 and 104.5, but I am not sure how good these are. The next support and note will be the lows of the first week of February 2023 at 83 even, the mid-February low at 83 3/4, and the early February low at 81 3/4. End of quote. I continued further, and it is an important piece I dealt with, and I quote, the only other feature to consider is a new one I have drawn on my weekly chart, which is not as yet established, but which deserves consideration. It's an April to date descending wedge pattern, currently 76.5 to 106 even. This is still a nascent pattern, but one worth watching, end of quote. 8 weeks ago, prices breached and closed below this pattern, and it was no longer a nascent pattern, but the main pattern for the market's actions. I did 9 weeks ago, and I quote, the key feature to watch for, apart from the obvious breakout of the descending wedge pattern itself, is when the lower trend line crosses the purple neckline extension to the significant February to September 2020 head and shoulders top, currently at 77 even. This will be approximately during the week ending the 22nd of November this year. Well, we are into this key week right now, and last week saw changeover volatility that ended up with a weekly immediate countering key reversal down and bearish engulfing pattern, reaching and exceeding the primary target X on the downside at 65 1/4. I will detail Target X shortly, but I'd first like to address today's reactionary move back up over the purple neckline and the dark blue lower trend line, but seemingly halting at the next resistance, one that has capped prices in the past back in mid-September, and that is the green short medium moving average, currently 84 even. With just today's actions, I am not convinced of the pressure behind this bullish move. But as I said last week, and I quote, it is very, very precarious, especially today, end of quote. So what have we in the way of opportunities and barriers on the downside and top side? I'll try and keep it simple and smart and short, as the much larger picture has even me somewhat scared. So below the dark blue lower trend line, look to the November 2021 low at 68 even, and then the congestion zone between 55 even down to 45 even, dating from July to September 2021. In a bigger picture, I had previously looked for opportunities presented by the break below the descending wedge pattern. A move below the November 2020 low, which was reached last week. Going back a bit, the break below the descending wedge pattern, a primary target, is the previously mentioned Target X in the 65.25 zone, just below the November 2021 low, and which was reached last week. However, the secondary much harder to reach Target X1, well, that is quite a way lower, way down in the one even zone. Yes, one even. And this has gotten me somewhat scared, as this is below what I know to be prior lows, notably my 2009 low at 22.25. All this is without even considering the implications that just possibly the move lower may have triggered targets, finally triggered targets, for the huge 2022 to 2023 diamond top pattern. And on that, well, I shudder at the thought of it. Well, meanwhile, topside, well, we have Fibonacci congestion at 104.5 and 107.75, but we also have a changeover gap from September this year, between 109.25 down to 100 even. And though it is a changeover gap, it still deserves consideration should prices try this high. Just be aware that we have the upper downtrend not too far away.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.